Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Josef Schachter, founder of the Schachter Energy Report, online at SchachterEnergyReport.ca. He's speaking to us from Calgary. Welcome back to the show, Joseph.
My pleasure, Jim. Good to be with you again.
Joseph, the Supreme Court of Canada ruled on the Trans Mountain Pipeline opposition by the BC government that the BC government does not have the right to say what can and cannot be shipped in pipelines through the province. Was that a good heads-up ruling? It was unanimous, 9-0.
Yeah, and the decision, how quickly it came down, I think the press said that it was, 30 minutes or something? That they made the ruling and came back with it. So unanimous and quick decision. I think that it's federal rights is good. The important thing, of course, is it's going to take time to build. It doesn't mean that this goes away. There could still be opposition in the lower mainland where they could block it, or there could be issues where the RCMP get called in for protests and things like that. But I think a clear ruling and a quick ruling was definitely something that was a positive. It really hasn't impacted the market today. The price of oil is holding just over $58 a barrel after the run up that it had. When we had the issue of the Iran attack on the U.S. bases, and then after Soleimani was taken out by the Americans, and we were up around $65, $66. We're now sitting in the 58 range, and I think we're going to see somewhat lower prices in the near term, simply because U.S. inventories are growing, as we saw with the EIA data. We can go into that if you want, but the bottom line is, yes, it's positive that we have this go-ahead from the federal government. It's positive that the Premier of BC said that they want the coastal line built. They want LNG business, and that the clean, air in China and India need Canadian natural gas, so that they don't use as much coal and dung. And so, there's been a few good rulings and a few good announcements, but again, it's going to be years before that impacts the economies of BC and Alberta, outside of the construction of coastal, which is going ahead, and somewhat in terms of TMX on the Alberta side of the border.
In terms of fuel, does anything get cleaner than natural gas?
At this point, that the natural gas and clean natural gas, without with the removal of any sulfur and other stuff that can be in there, that is the cleanest burning fossil fuel. And if we can transit from coal to it at the same time as we're pushing forward on renewables, tidal, wind, solar, all of those are going to be needed for the growth and demand in the decades to come. Remember, most of the growth that's coming is coming from Asia and from emerging markets, South America, Africa, and most of them, are going to need to go off coal, and for the planet to be a winner, especially, of course, China and India, where you have the big density of population.
Right. When did this whole thing about, oh my God, natural gas is a fossil fuel and it's dirty come from? Because as late as, say, 3 years ago, people were still saying natural gas, a great alternative to using other kinds of fossil fuel. And I just look at the skies of Vancouver where you can see the mountains every day of the year. Back in the 80s, it was a blue wall and you couldn't see across the street.
Well, again, we were using a lot more coal, and in the old days, and Alberta's converting from coal-fired to gas-fired facilities here for our electricity, and in the U.S., their air is cleaner now as well because of what Obama did when he pushed through legislation to close the coal. And even though Trump is in favor of coal, more and more facilities are being closed because the economics of natural gas versus coal are definitely in favor of natural gas right now. So I think that, while we want to see wind and solar, et cetera, it's still going to require for many decades fossil fuels, and of course the one that is the cleanest is natural gas over crude oil. But remember, crude oil a lot more is being used not for transportation but for industrial products, chemicals, fertilizers, all kinds of product areas. And as those product categories grow, they're going to use oil and upgrade it to create the products that you and I use every day in our lives.
I can see 100 years from now, people are going to say crude is so valuable for all those things, petrochemicals, pharmaceuticals, and so on, that you really burned it to get around. We can't believe that.
Yeah, well, if you remember, candles, then whale oil, and so we've transited a lot, and hopefully over time, we go to cleaner and cleaner, so that the planet, temperature doesn't rise, and the problems, of course, that we're seeing in Australia, and also remember 2 years ago the fires in BC, and the impact on both of Alberta and BC because of the quality of the air.
Overall, how is the crude oil market looking for 2020?
We're optimistic. We had a range in Q1 of, expecting 54 to 66. So far it's been, 57 to close to, 65 or so, or over 65. So the range for Q1 is fitting within our model. But we're looking for the model to move up as each of the quarters. So we're looking for a high in Q2 of maybe 76, a high in Q4 of Q3 of 78, and then in Q4 north of 80. And then we're looking for an average this year of $70 US per barrel. And then for next year, we're looking for even higher prices, $80 average for the year, with probably spikes into the 90s. So it moves around because of anything that happens, internationally, i.e., the Soleimani thing, and or if there's a tax on, like we had with Saudi Arabia on the OPEC production facility, and then on the downside, when you have big inventory builds and there's quiet on the international stage, then you have prices come down. And so, after the Iran retaliation on two, really low populated bases, just to show that they could do it and that they had the ballistic missiles that could do it. And today we're hearing that there were 12 injured Americans that were taken to hospital in Europe. But the reality was there was no, deaths, which is, of course, good. But the bottom line, to me, is that we're looking at higher and higher prices because OPEC has done a great job of managing supply. Saudi Arabia cut back production in October and November, and then in December again. So the December data came out this week, and Saudi Arabia cut back 151. That's November. Cut back by 111,000 barrels a day to 9.76 million of the 161,000 BOEs a day that OPEC cut back. So those were, that was supportive. And then, of course, since then, we've seen the announcement that in Q1, where we're in Q1 already, that the OPEC is cutting back production by 500,000 barrels a day, of which 400,000 is being cut back by Saudi Arabia. So they're managing supply and demand. So it'll tighten up because demand always picks up in the winter, slows down in Q2, and then picks up for the summer driving season, backs off in the shoulder season of the fall. So they're managing that process. At the same time, we're seeing the U.S. shale numbers coming down. And, for example, in the Permian Basin, we're seeing the rig count still pretty sloppy. It's down, they announced this morning 403 rigs working out of versus 481 a year ago. So the rig count in the Permian is down 16% from a year ago. And the overall U.S. rig count was 796 rigs working, down from 1050 that Baker Hughes announced today. And that's down 24%. So the U.S. production profile, especially with the high decline rates of new production, means that we're, with 13 million of production right now, according to the EIA, the U.S. may not get to 14 million, which has been the forecast. It may only get to 13.4, 13.5. And if that's the case, because of less spend and less drilling activity, that would, again, model in for higher crude prices heading into the latter part of this year, second half, and then, of course, even more so in 2021. And the EIA put out a report this week which shows that in terms of worldwide inventories coming down in 3 out of 4 quarters in 2021.
With low prices, is anybody looking for new oil in Western Canada?
Well, companies have to replace their decline rate. So, they're going to spend cash flow to keep numbers flat. Many companies are using their, with commodity prices been a little more robust as they got into the 60s, they were going to have some surplus, free cash flow, which they were going to use for paying down debt if they had a debt issue, or for their normal course issuer bid. And we've seen many companies make announcements of utilizing their NCIBs and then planning to reinstate them, once they expired, because they're 1-year kind of transitions, and getting approval from the exchange to continue with an NCIB. And almost every day we see announcements of that. So I think that, we're not going to see much production growth in the Western Canadian Basin, because if you look at the WCS differential, which is, getting into $23 to $25, per barrel, versus rail cost of 17-18, while we're seeing U.S., imports of Canadian oil going up, the issue, of course, is that, we need more rail capacity. And, the data from this week from the EIA showed that the U.S. Imported 3.84 million barrels from Canada, 47.7% of their imports, and that is up from 3.6 million the week before and 3.57 the year ago. So we've increased our exports to the United States, and that all relates to the issue of the using more rail.
We'll have more with Josef Schachter right after the break.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the 2019 drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Welcome back. We're speaking with Josef Schachter. Joseph, how is natural gas looking for 2020?
Natural gas, we're seeing AECO prices, doing quite well because of the cold weather here. And I think that, the cold weather, doesn't look like it's going away so quickly here. So we're going to be looking at stronger demand and low inventories right now in Western Canada. So we're going to be seeing, more robust demand within Canada. I think we're looking at a $2.60 price right now for AECO. And so that's a very nice price at this time of year. And that compares to, if you're looking at natural gas, for NYMEX, it's trading around, $2.01. So we have a nice Canadian dollar price, much better than what you have in the U.S. at this time. And again, I think that's part of what we're going to expect to see, going forward, because the industry is not spending a lot of money until we see the coastal line on. And so it means in 2021, 22, we'll start seeing more drilling to build up reserves to fill that pipeline in 2024.
Now, during the railway strike, Quebec was running out of propane. Is that a good argument about why there should be a natural gas pipeline from Western Canada into the east?
I think there's lots of good reasons for it. Do we want them importing natural gas from the United States versus using, Canadian domestic sources? And then, of course, the issue of propane for heating. I think it was Pembina sent a whole rail car, or rail line, a full train load, to the east because of the shortage and the high prices that were occurring because of the lack of product. So I think that, over time, I think we're going to need to see, some resolution of this. And, part of it could be is if we have any disruption of supply from the Middle East and prices take off, Quebec could be going from, saying, well, we can buy cheaper from Venezuela or Saudi Arabia or Iraq, to saying, oops, Western Canadian crude's, a better deal, plus we have security of supply. So it'll be the cycle as it unfolds. I think we're going to see north of $100 oil in 2 to 3 years, and I think at some point, in the next few years, we may even exceed the Q2 08 high of $147 a barrel, but that will be predicated on some disruption of supply from the Middle East from any of the major producers there. And if that does occur, then Quebec will be realizing that they're in trouble getting imports into the province, and they may then be in favor of something happening on that thing. But again, it's many, many years away before anything will happen in terms of approvals, and then many, many more years before anything goes down in the ground in terms of pipe to bring product from Western Canada to Eastern Canada.
Is the climate change narrative causing problems for Canadian oil and gas producers?
Yeah, there's a lot of issues on ESG, and some places like Norway saying they're not going to invest in energy companies around the world, even though Norway still gets the bulk of their revenues from the North Sea and a lot of their tax revenue. But they're moving very, very quickly to electric vehicles and any other kind of environmentally renewables that they can bring on. So they're a leader in that. Germany is trying to get off coal, so they're importing natural gas more and more from Russia, from Gazprom. So the ESG thing is, from the point of view of companies' disclosure, you may have seen the Suncor announcement that they're going to do a cogen facility up north so that they won't be burning, oil, which of course will improve their emissions by 30%. You've seen Cenovus's announcement. I think that relative to other industries in Canada, we are seeing that the energy industry is showing leadership in terms of movement, in terms of, getting their numbers down, and also leading in terms of new technologies. So I think as people start looking at it in every other industry over time, I think they're going to start to realize that the energy industry has been very correct in responding to the crisis, and that the technologies, use of water, emissions, that the industry is responding very effectively. And you're seeing a lot of companies talk about getting down to zero net emissions. And again, who would have thought?
We'll have more with Josef Schachter right after this.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Josef Schachter. So overall, what is the latest on building pipelines in Canada? Once Trans Mountain's done and the natural gas pipeline in northern BC, do we have any future for pipelines in Canada?
Well, I think the issue is you separate them between oil and natural gas. So oil, if, because the federal government owns it and the Supreme Court has ruled in favor of going ahead, that will bring on, incremental, 500,000-600,000 BOEs a day, which when you realize an industry is doing, 5.5 million, that's like a 10% increase, that will happen. There's tweaking of the lines, between Canada and the United States that will add, 300,000 to 400,000 BOEs a day of new capacity over the next few years. Of course, there's the capacity for more rail over time. So, the industry potentially still is going to have some decent growth, but it's going to be limited, and of course the XL pipeline could get, some movement there, given the recent TC Energy announcements, which would add, a lot of capacity, but again, many years down the road. Natural gas is the one that I think we're going to see, more pipelines into from Western Canada heading south to California. We're going to see more pipelines heading into the U.S., into the Midwest. We're going to see, hopefully, not only phase one of LNG Canada, but phase two. If Horgan is, the Premier of BC is keen on having more than just one LNG facility, then that would create a lot more demand. So when you're looking at the two commodities, I think there's more upside in this decade for natural gas volumes and more natural gas pipelines than there is for oil pipelines and crude pipelines, liquids pipelines. So I think that the natural gas business in Western Canada, both in Saskatchewan, Alberta, and BC, looks pretty good. And once we start seeing that takeaway capacity come on by late 2020, I think we're going to see much more robust prices and better netbacks, which number one is helpful to the companies, also helpful to the provincial governments in terms of tax revenue, royalty taxes, and also, of course, for the industry to spend more money, more jobs being created, and more, people being employed and paying taxes as well. So, all in all, I think, the latter part of this year we'll see much better response from the energy industry. The stocks are very cheap, and then over time, as those volumes come on and more activity occurs in the patch, that will have a lot of response and benefits to all the constituents that are part of the energy side of the equation.
Is the oil and gas sector transitioning from labor-intensive to more technology and automation?
In terms of, the field, instead of having people go and check every well, there's a lot more automation going on there. Of course, in the, in situ thermal oil sands, they're always looking at new ways, with automated trucks and other things to handle the labor shortage issues that they've had, and also to make things more operating efficiency come from a cost point of view. But I think the key thing to remember is the energy industry is a technology industry. Fracking wasn't around 20, 30 years ago to the degree it is today. The type of usages that they have in drilling, the drilling time that's now is much shorter than it was a decade or two ago. So the energy industry, because of the importance of it, and because the industry, has been pressured by low prices to become more efficient, that has all been, part of the change here. And of course, it's been a big positive in terms of jobs on the the science side to find solutions to everything from the emissions issues, drill time, productivity, well performance, right across the board. The industry, has had great response and great new technologies that have made the industry much more efficient.
In 2020, are you more bullish on crude oil or natural gas?
I like both of them. As I said, I think crude oil by the end of the year could see prices, averaging 70 and north of 75, heading to 80. But I think natural gas prices, which, have been, sub, $1 in the summertime, and then you get $2 to $3 in the wintertime, and you end up like $1.60 for the year, like we have in past years. Because of the TC decision where you're going to have ability to store gas during the summer, a lot of people I talk to in the industry think maybe we'll see prices around $1.50 in the summertime. But if we hit to, $2.50, $3 in the wintertime, that means you'll see a $2, $2.20, $2.30 average price for the year, which means a much bigger bounce than you'll see in oil. And then once you get close to the new pipelines for the LNG, we could be looking at $3 plus at the wellhead, which of course would be fabulous for the industry and would provide them with the cash flows to spend drilling and bring on the production that will be needed for LNG. Like, for example, Right now, the production and demand is around 14, 15 BCF in Western Canada, and there's maybe a half a BCF too much, and that's why you have low prices, during parts of the year. But if you add in all the new takeaway capacity going to the States, the internal demand within Alberta for the coal conversion to natural gas conversion, and you take into account the new LNG, from LNG Canada, we're going to need 5 to 6 BCF. So we're talking about a third increase over the next 3 to 4 years in terms of the capacity of natural gas. And right now the industry is not making enough money to spend any money on increasing capacity. So the bottom line is we're going to need much higher natural gas prices for the industry to have the cash flow to increase production to meet the growing demand in 2024, 2025.
Does the pipeline industry have to do a better public relations exercise explaining to people that modern pipelines are probably a whole lot safer than the ones that are in the ground right now that were built back when Elvis was born?
And also much more efficient and much more environmentally secure than rail, as we all know. So yes, the industry is beginning to become more outgoing in the discussion of the issue and in terms of their explaining it. And of course that's part of the process for people to understand, that the industry is not asleep and that they are working proactively to make things more efficient, cleaner, safer. And I think that disclosure and that discussion is occurring. The war room that Alberta's got is there for any misconceptions that people have and to try to rebut, what the environmentalists from the States who have been coming into Canada and creating quite a ruckus. I think we all know that, that has been a deterrent to the industry. And, I think that, that is going to be something that, over time will put a safer, industry, but also make it more fair, because the attacks are coming from people in the U.S. that want to stop Canada from having export markets to Europe and Asia, because they want us to be a captive client with low prices for them. And that to me is unconscionable.
What's new at the Schachter Energy Report?
Well, we're just in the process of getting ready for the next publication. We're introducing coverage on a new company, so that I have to keep just for our clients until they see the report. We're looking at new companies on a regular basis to add to, where their companies are doing proactive things to create shareholder value. In the newest report that's coming out next week, we go over the insider trading reports. So we show, the companies that are buying back stock, where the insiders, both management and directors, are buying stock, which tells you that they think their stock is cheap. So we're trying to add value to our subscribers, who are mostly individual investors, both on individual companies. Mostly right now, of course, is explaining the macro view to them and how we see that unfolding. And then I'll be speaking at the World Outlook Financial Conference on Feb 7th in Vancouver. So we're busy with both road shows as well as a product for our client base, and that keeps us busy every day of the week.
Joseph, how can people find out more about the Schachter Energy Report?
Yeah, we provide a product that, where we do 2 on 11 months of the year, except for December. We provide 2 reports every month. Every quarter we do a webinar, so we go over, people can ask us about individual names, and, and we can talk about our view of the company without specifically saying it's appropriate for the individual. That's something the individual has to do with their own investment advisor. But they can go to www.Schachter, Schachter, energyreport.ca. There's a couple complimentary copies there so people can see the reports. We do tweets every week so they can see the updates there. And then then they can go and either become a subscriber on an annual basis or a quarterly basis, and then be receiving the product. And we cover everything from large caps like Tourmaline and Vermilion, all the way down to very small caps. We don't cover the integrated companies, but our focus is on the more entrepreneurial side of the industry, both on the energy and energy service sectors. So there's 32 companies right now covered, and next week that'll become 33.
Joseph, thank you so much for being on the show.
My pleasure as always. Thanks so much, Jim.
My guest has been Josef Schachter, founder of Schachter Energy. He's Energy Report. You can find him online at schachterenergyreport.ca. He was speaking to us from Calgary. If you have any questions for Josef or any of our other guests, you can send them to info@housestreet.com, our YouTube channel, Talk Digital Network. Find us on Twitter @HouseStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HouseStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HouseStreet.com radio is a production of House Street Media Incorporated.